The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Well, hello, everybody. This is EG Tax. It's not Esther. I told you last week. We gave her 2 weeks off. She's enjoying the heat in Chicago right now. But this is Chris Fabian. I'm here to help you with your taxes, whatever you may need. And give us a call here in studio, 803-0930, 803-0930, star 930 on your cell phone. Text in those questions to 716-803-0930 as well. We do have a special guest today, continuing our summer series. We have Russell J. Gullo, who is the president and CEO of R.J. Gullo Companies. So, Russ, how you doing today?
Good, Chris. It's a pleasure being here with you.
Yeah, it's a great day. You know, we don't have the extreme heat yet, but it's getting back up there.
Beautiful out.
It is. It's absolutely gorgeous. And I know people are probably out there by their pools, the Eden Corn Festival, doing something. But if you're listening, you can get great advice because, Russ, what is it? What is R.J. Gullo?
Chris, the R.J. Gullo Companies is a group of companies that provide real estate investment services specializing in 4 particular areas. The first is being a 1031 exchange, which is the opportunity to pay no tax when you dispose of an investment piece of real estate. The second is our real estate investment brokerage services, meaning that we match both buyers and sellers of multifamily investment properties. The third is management-free real estate investments. And I break that up into 2 categories. The first one is if you want to acquire a management-free investment on your own, you have the opportunity to buy something like a triple net lease. An example would be maybe a Dollar General store, in which you would need a minimum capital of about $500,000 and the use of leverage, and that would give you the ability to go out and buy something that's totally management-free. Now, if you don't have $500,000 in capital, there's a second option, which is a form of a co-ownership investment, which you need a minimum of $100,000, and you need to be deemed what's called an accredited investor, and then you're able to buy into what's called something like a DST, a Delaware Statutory Trust, in which you become part of a large portfolio, as an example, and you basically get your cash flow distribution on a monthly basis, and then you get your other benefits when you dispose of the asset. And then the last service that we provide is real estate investment counseling. So if you are a real estate investor and you're looking for advice, you may want to just go to our website, which is www.rjgullo.com, or you can call us at 716-675-1500, and we would be more than happy to provide a free consultation with you, putting our 80 combined years of experience to work to figure out what service we can help you with.
All right, very interesting. Yeah, you hear, the listeners, you hear us all the time on this show talking about 1031 exchanges and what to do and how it can benefit you, and what the main purpose of it is to, one of Esther's favorite things is defer, and die. And that's what a 1031 exchange does. It defers your gain on a property because you're exchanging one property for another property. And I know this is where people get confused. They go, wait, I have to trade houses with somebody? But
exactly, Chris. So in regards to a 1031 exchange, it's an opportunity to pay no tax. And Section 1031 of the Internal Revenue Code is nothing new. It's been around since the beginning of the Internal Revenue Code. 1913, actually. And then in 1921, it took on the citation of Section 1031 as part of the code. And it's a great opportunity for those individuals that would like to create wealth in real estate. And with the use of Section 1031 and the use of leverage, the values that you can control with that formula is just phenomenal. I know, Chris, earlier you and I were chatting about a client of yours that started with very little capital and very few properties and built a very nice portfolio of real estate investments. And with the use of 1031 and the use of leverage, people are able to do that.
Right. It's amazing what that tool is. It sounds very confusing and all that, but to me, I think one of the hardest things with the 1031 is the time frame. And that's what people don't understand.
Exactly.
And could you explain?
Sure. Chris, why don't I start from the beginning?
Sure.
Let's assume somebody owns an income-producing property, what we call trade or business, or an investment-held property, which means that it's an asset that you're holding for future value in the eyes of the IRS. An example of that would be raw land. So let's assume somebody owns one of these income-producing assets. It might be a double or a duplex. And they decide that they've held this asset for a number of years. They created some additional equity through the principal pay down of a mortgage, as well as through the increase of value through appreciation. So now they're at the point, and they think their best play is to hold that asset until they're mortgage free. And that's really not the formula with investment real estate. That works great if it's your primary residence or your secondary residence. But if you want to maximize your rate of return and you want to create wealth much quicker, again, you don't want to hold the assets until you're mortgage free. So, I mean, that's what we see all the time. So once we re-educate or reprogram the clients, they fall into the category of taking advantage of a 1031 exchange, which means that they need a buyer. They need a buyer for the property that they're disposing of. And then once they have a meeting of the minds, anytime prior to closing, they bring in what's called a professional qualified intermediary. And I've been providing qualified intermediary services nationally for the past 45 years now. Our company was one of the first independent qualified intermediary companies in the country, headquartered right here in Buffalo. So we're brought into the transaction, and the way that we're brought into it is the seller, the taxpayer, the client needs to just do nothing more than to email us a copy of the contract of sale. That would allow us to prepare all of the exchange documents that need to be executed prior to closing. We email those back to our client. We email them over to the client's attorney or title company with instructions explaining how the net proceeds have to be paid and who they're payable to. And that actually puts us in the deal. The rights of the contract are assigned to the qualified intermediary prior to closing with a simple assignment agreement. That's an IRS requirement, and that's how we get involved into the transaction. And once that's done, we're ready to go. So we're ready to close on the relinquished property, and the day of closing starts the clock. And to get back to the timeline, Chris, that you mentioned, from that day, that's day one, the client, Mr. and Mrs. Taxpayer, or the exchanger, have 45 days to identify a property, what we call a replacement property. And they can rely on either what's called the 3-property rule, which they can identify up to 3 properties of any value on our ID form, or they can also use another form of identification called the 200% rule, which means they would take 2 times the selling price of the relinquished property. And whatever that total value is, they can identify more than 3 properties, but they cannot exceed 2 times the selling price. Okay.
Yeah, so you can, if you're listening, you can see it can get very interesting, very confusing. We're going to talk more about 1031s and why you would want to do a 1031 after this short break. And we're back. EG Tax here to help you with whatever tax needs, questions you may have. The confusing big beautiful bill. Taxes in general are very confusing. And we do have our special guest today, Russ Gullo from RJ Gullo's companies, talking about 1031 exchanges. And before we get back into the confusing thing, I want to the people out there who have rental property and wondering, why would I want to do it? Well, the thing is depreciation. Depreciation is a great thing every year when you own that property. So you buy a property, we'll say for $200,000. Well, every year for 27 and a half years, you get to write off about $6,000 of that. So as a paper expense. But what people don't understand is that $6,000 a year brings down that $200,000 purchase price by that $6,000 every year. So at the end of 27 and a half years, your tax basis is zero. So now you go to sell that property, and we'll say that $200,000 property is now worth $500,000. You have to pay tax on the whole $500,000. And that's a lot of money you're going to pay tax on, both the federal and the state. But the thing is, what a 1031 exchange does, like I said, Esther's favorite thing is defer, die, is pushes off that $500,000 gain until you sell the new property that you exchanged your old one for. So you may not have any depreciation unless you had to come up with some cash to buy the new one as well. But you're not paying tax on that $500,000 right now. And the thing is, that $500,000 gain could cost you could cost you almost $150,000 to $200,000 to the federal and the state. So the gain you had is gone. So, but at least the exchange moves that money, just like stock. Think of it as stock. You bought Apple stock at $2 a share. Now it's worth $150 a share. The difference is you sell that Apple stock and you buy some AI stock. You have to pay tax on that Apple stock. The difference here is for rental properties, you're exchanging it and you don't have to pay tax. And that's a lot of savings for a lot of people. And I know I've had a lot of clients who did this, and they were so happy. Some people were so mad because they didn't know about a 1031 exchange. And once you get that cash in hand, there's nothing you can do, right?
Right. Chris, in your example where you're fully depreciated, as a rule of thumb, the tax liability is basically a third of the selling price between the recapture of depreciation, the capital gain, and New York State. And you may also have the net investment income tax, depending on the taxpayer's income
and the sale price.
But as a rule of thumb, without even doing the math, I mean, that's what we see all the time. And I'm amazed at the number of people that do not know that when they dispose of the asset, like real property, that there's such a thing as depreciation, as you mentioned, the paper loss. All we ever hear about from our politicians is capital gains. I've never heard to this day a politician talk about the recapture of depreciation. So most people are not even aware of it unless they get tax advice.
Right.
And how many clients, get tax advice before they had a meeting of the minds between them and a buyer. It's pretty sad.
Not as many as we would hope, because people hear us all the time saying, call us before you do something.
Absolutely.
Because after you do it, it's too late.
Absolutely.
And that's the
Chris,
same.
to answer your question, though, as far as if the funds from the sale, the proceeds go to the client, to the seller, they become taxable. It's one of the first things that IRS agents is trained to look for in the event of an audit. What we call actual or constructive receipt of the funds. The IRS requires the net proceeds to go to the qualified intermediary. They go into a restricted escrow account for the benefit of that client, and they're used to acquire the replacement property. But that's an IRS requirement in order to do a 1031 exchange.
Right. And it's not, you can't make money off the escrow account. It has sit in an interest-bearing A non-interest bearing.
So those funds would sit in an escrow account, and they're used by their client. Again, they have to identify the replacement within a 45-day period. They have to close the replacement property within a 180-day period. The 45 is part of the 180.
So that covers New York State.
Yeah. So, I mean, that's the timeline. And in order for the funds to be payable to the qualified intermediary, the rights of the contract have to be assigned to the qualified intermediary prior to closing. And that's what puts the qualified intermediary into the deal, who is also acting as a qualified escrow agent.
Okay.
Those are two safe harbors that are part of Section 1031 of the Internal Revenue Code.
Now, do I have to, if I have a fourplex, do I have to buy another fourplex?
No. And that's probably the misunderstood term, what we call like kind. So like kind pertains to the character or nature rather than the quality or grade. In layman's terms, Chris, all that means is you dispose of real estate, you have to buy real estate. So if you came out of, for example, a piece of land, what we call an alligator, a negative cash flow position, you can buy a multifamily. You can come out of a mixed-use building, maybe in Buffalo, and buy a condo in Tampa. You can buy anywhere in the United States. You don't have to sell Buffalo, buy Buffalo. You can buy any property as long as it's available for rental. It doesn't even have to be rented, or something that you're holding for future value, what we call investment held.
Right. Now, can somebody buy a property in Mexico or Italy?
The only way you can buy something outside of the country is if you are a U.S. citizen, you file a U.S. tax return, and let's say you own a income producing property in Italy, you can do what's called a foreign exchange under Section 1031, which means you have to buy another replacement property in Italy.
So they can't take the one from Buffalo and buy one.
No, and you know what, Chris? With us being located so close to Canada, I can't tell you how many times over my 40-plus year career that question has come up. Can I buy a condo? Can I buy a cottage in Canada? I live in Buffalo, and that does not qualify. That's not what we call like kind.
Yeah. And if I know I've had people who've had condos in Canada and they've rented them out. Can they take those funds and buy in the States, or does it have to stay in Canada?
Has to stay in Canada.
Wow.
Yes, has to stay in Canada. Yeah. There is some case law that allows territories to qualify, such as Guam and the Virgin Islands. We get quite often we get asked about Puerto Rico, and people don't realize Puerto Rico is not a territory, and they have their own tax code.
Yep.
It's not part of the Internal Revenue Code, so
right,
it doesn't qualify.
Right. Yeah, they have their own tax return. And they could choose: do I want to pay taxes in the U.S. or do I want to pay taxes to Puerto Rico?
Right.
And so it's a totally different animal altogether.
Exactly.
Yeah. So you got to be careful, but they can take a house and exchange it for commercial property.
Absolutely, Chris. I'll give you some examples. If you came out of a 4 units, and maybe you decide I want to go into a triple net because I want to be management free, or maybe I want to come out of an active role of property management and I want to go into a passive role, like one of these DSTs, these management free investments, or they want to buy maybe a plaza that might have net leases. That's another way. Absolutely, that's all deemed of a like kind. And they can buy anywhere in the United States. We coined a phrase many years ago, the Sunshine Formula, where in the Northeast we see an awful lot of clients selling an income-producing asset, maybe buying a condo, as you mentioned, maybe down in Tampa, with the intent down the road to convert that to maybe a primary or a secondary residence after seasoned, with the proper seasoning. And then, converting that to a secondary residence so they have the ability to get out of our cold winters.
Where do you see it being a hot market right now? Like people from Buffalo, where's the hot place for them to buy?
Believe it or not, Buffalo, when you look at the cost of Buffalo real estate, it's one of the cheapest markets in the country. And we see a lot of people from New York City, from California, shopping Buffalo, believe it or not,
Wow.
Western New York. We were just chatting about Florida. Right now is a great time to buy Florida because of what's happened with the hurricanes in 2024. The percentage of values have really declined right now, especially on the west coast of Florida.
That's crazy. How much? I mean, your prices are going down for the property, but your upkeep is going up.
But the operating expenses are increasing. Absolutely.
Oh, but well, that's a tax write-off. If you have any questions for us in studio, give us a call, 803-0930, 803-0930, star 930 on your cell phone. Text them in, please, at 716-803-0930. We'd love to hear you. You get free advice on this. It's a great way to save money. It's even a great way to plan for retirement. And, we'll talk about that after we do the news, but there's so much information Russ has. He's the, Esther's the guru of taxes. Russ is the guru of 1031 exchanges, and I know I've had people say, oh my God, why would I want to do this? It's going to cost me $5,000. That's ridiculous. Well, do you want to pay $150,000 to $200,000 in taxes, or would you rather pay $5,000? That's a good question before the break. Think about that one. We're going to break for the news. We'll talk to you on the other side. That's right, family. We love you. We want to inform you of everything going on, taxes and everything else financially. That's why we do our summer series, because we want to help you keep money in your pocket, because that's where it belongs. So Chris Fabian from EG Tax here. Give us a call in studio, 803-0930, star 930 on your cell. Text it in, questions in to 716-803-0930. And we'd love to hear from you. We have special guest in studio this week, Russ Gullo from RJ Gullo's company. He is a 1031 specialist, and we're talking how to avoid paying taxes. And I think that's perks up a lot of people's ears, because that's always the big question. How can I avoid paying taxes? I don't want to pay taxes. Well, this is what we're talking today is one of the only legal ways to do it, to not pay taxes. And that's doing a 1031 exchange. And, we said before the break how you could use a 1031 as a form of retirement. And, everybody's, I want just a monthly income. I don't want headaches anymore because it's a pain dealing at 2 a.m. My hot water tank went, my heater went, something like that. And there are ways with the 1031 where you basically, we'll call it a retirement check and an annuity check, something like that, where you can exchange tax-free. Your money's still your money, but you collect a monthly check and you do nothing, right, Russ?
Absolutely. Chris, which is very interesting. I've been doing this for 40 plus years, as I mentioned, and I've been working with clients since that time that I can tell you numerous clients that started with maybe a couple of doubles, single-family rentals, 4 units, and they're at the point right now where they build a fabulous portfolio of maybe 100, 200, 400 apartment units, and they're at the point in their lives where they don't want to do the day-to-day management any longer. And the best tool that they have available in their toolbox is Section 1031 of the Internal Revenue Code, because they're able to take all of their equity and they're able to come out of an actively managed portfolio or property of real estate and go into a passive, a management-free real estate investment that would be deemed of a like kind to finish a 1031 exchange. And as I mentioned, there's a couple of different avenues that they can take. They obviously can go out and hire a third-party property management company and pay them a fee. That's one avenue. Another avenue is they can go into what's called a triple net real estate investment. And as I mentioned, an example of that would be maybe a Dollar General deal. And let me just go into detail with that, Chris, for a moment.
Sure.
Let's assume that a Dollar General, brand new construction, is being built, and you as a real estate investor are able to buy that asset. Now, Dollar General doesn't own real estate, and that's the reason they're able to build 700 to 1,000 stores a year. They don't have that mortgage on their balance sheet, so they're able to expand their business as rapidly as they do. So they basically look for people to buy the real estate, and they create a 15 to a 30-year lease. And that lease is what we call a triple net lease, meaning that the taxes, the insurance, and the maintenance are the responsibility of Dollar General, who happens to be the tenant, in addition to the utilities and the rent. So at the end of the day, Chris, if you have $500,000 of capital, you can go out and buy one of these Dollar General deals, brand new construction, and with the use of leverage, as I talked about, you can get a mortgage for the difference, and you can own this building by yourself. And the rent, the cash flow, comes to you on a monthly basis. So now you own this asset, and you fulfilled your 1031 obligation, and life is good. Now, if you don't have $500,000 of capital to reinvest, or you don't have equity of $500,000 to reinvest through the assets that you're selling that you want to do a 1031 on, you might have something with as little as $100,000. And with $100,000, if you're what's called an accredited investor, you're able to buy into a co-ownership investment, which might be a $100 million portfolio of maybe multifamily properties that might be scattered, from Florida to North Carolina to Arizona, and you become a percentage ownership of that portfolio, which does qualify as like-kind for 1031 purposes. And it's kind of like a REIT, a real estate investment trust, but a REIT does not qualify as like-kind because even though you own real estate in a REIT, you get stock in a corporation, which is not like-kind to 1031, where our government back in 2002 and 2004 came out with a RevProc allowing a DST, a Delaware Statutory Trust, which is the entity to qualify. So that's a great opportunity, depending on whether your client or the investors at the point in their lives where they decide, hey, I want to stay into real estate, I want to take advantage of this 1031, but I don't want the responsibility of the day-to-day management.
Right, and that's and if it is the Dollar General, whatever, you don't have to do the parking lot, you don't have to do the heating, the cooling, you do nothing.
Absolutely.
Everything falls on to the Dollar General.
Absolutely.
They pay for everything for the property. You just sit back, have a margarita, and get your check.
And Chris, of course, you have to do your due diligence, just like you would with any investment that you make. You have to pick the right company. Now, Dollar General is what we call an investment grade. So they're not all created equal.
Okay. Oh, we do have a text. It says, you keep mentioning rental property for exchanges. Can I do this with my business assets? I'm a landscaper.
So what's happened about 8 years ago, our government amended Section 1031 of the Internal Revenue Code. We were able to do both personal property and real property, but they amended it to read today that only real property qualifies for 1031 purposes. I mean, over the years, Chris, we've done all kinds of aircrafts, numismatics, portfolios of wine, all kinds of equipment, FF&E, livestock. Every time we did a farm, we did livestock. When we did a hotel or motel, we always did the FF&E that went with it. But that does not qualify today. Just real property does. So now, if that caller has real property as part of the business, the allocation that's being made to the real property would qualify, but not the allocation to the business.
Okay.
So it might be worth a phone call.
Yeah. But we'll go back to the farmer. What if the sale price of the farm included the livestock?
The livestock, again, we would carve out the livestock today. We would have to carve that out.
Okay.
And the real property. And with most farmers, part of it is also their primary residence. So we would also carve out under Section 121 of the Internal Revenue Code the primary residence portion.
Wow.
So it's always good to, as I mentioned, we provide free phone consultations. It's always good to use us as a bouncing board to see whether or not your deal qualifies.
Right. And so for a rental property, though, you don't have to carve out the appliances or anything like that.
No, typically when they become attached, they're deemed real property.
Okay. So, yeah. So, as like I said earlier in the show, it does get confusing, but that's why you want an expert on your side to help you understand and walk you through step by step for something like that. And what is the expected rate of return on something like a Dollar General?
Well, they do vary, depending on whether it's newly constructed or whether it's an existing lease. The type of asset that it is, the size of the asset that it is. But typically, I just did a couple of the Dollar Generals in Western New York, and those were bought for cash. And typically, they throw off about a 6.5% to a 7%, what we call cash-on-cash return, which is the relationship between the cash flow before taxes and the investment, what we call the investment base, the equity contributed to make that investment.
Okay. And can you... if you buy into one and you're getting sick or can you sell your share? How do you go about?
So Chris, in our example of the Dollar General, you actually own that by yourself. So you
Okay.
can make the decision when to buy, when to sell, how long to hold. If you're buying into one of these management-free co-ownership investments like a DST, typically, historically, nationally, you have a holding period of maybe 4 to 6 years. So you're locked into that period of time.
Okay.
They're not liquid like a REIT is. That's the main difference between a REIT and a DST.
Right. And just the same as a rental property, these Dollar General buildings or other things like that, they can be passed on to the beneficiaries?
Absolutely. So using a 1031 over and over again, and this is what most people don't realize, Chris, a 1031 exchange is just not a one-time opportunity. You can do this over and over again, and like you mentioned, you keep on deferring and deferring, and it's one of the best estate planning tools because when we pass on, when we bid this will goodbye, our heirs are then forgiven of those taxes, and their heirs can sell that asset the next day for the value that was put on by the estate tax-free. Doesn't get any better than that, Chris.
No, not at all. Take advantage of the law while it's there.
Absolutely.
Because who knows when they're going to change it. Right now, the estates are going up, and they're keeping the cost basis, doing the in stepped up value. But I know a while ago they were looking to get rid of the stepped up value, or they wanted to tax people on the stepped up value. So the government can do whatever they want whenever they want. And that's what people got to understand.
Absolutely. Chris, I learned many years ago that you work with what's available today when you do tax planning,
Yep.
whatever the tools are that are available today.
Yeah, I know people don't like when we say, we don't have a crystal ball, but we can tell you based on today, this is what it's going to look like. And, some people do appreciate it. Some people are like, rah, 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 rah. But hey, we just try to help, give the best tax advice out there. But 1031s are remarkable. I've seen a lot of clients, again, benefit from them. I know a lot of personal people who have done it, and it's amazing. And like you said, it's people can do this, and we'll say Florida, Tennessee, Texas, they buy a condo down there, they rent it for 2 years, and then they move into it.
Right.
And
exactly.
they don't have to pay tax. The only time it's their cost basis that's still reduced. So if they were to go to sell this property then later, then they would have
Right.
an
You'd have to
issue.
do the allocation.
Yep.
What part was deemed 1031?
Yep.
What part is deemed primary or secondary?
Right, but what a way to get a retirement
Oh,
home.
my God. Fantastic, Chris.
Use your assets up here to get your secondary residence somewhere else, rent it for a couple years. And
Absolutely. Especially right now, Chris, for those that are based in the Northeast, Western New York, that want to buy something and to be able to use it in the winter months, they still are able to use it, even though it might be deemed investment held today, maximum of 14 days.
Right.
14
Yep.
days, plus any time for renovation. But again, as you mentioned, after 2 years, they can abandon the use, change the use of that property to a secondary residence, And life is good at that point. It doesn't get any better than that.
That's incredible. Chris Fabian from EG Tax here to help you with whatever tax questions you may have. We're going to take a short break and come back for our last segment of the show this week. And we're back. EG Tax, helping you with your tax situation, whatever it may be. We're here to help you. You can reach us during the week at 632-7886. You don't have to wait to Saturdays to talk to us. We'd love to help you there. You get letters. You don't know what to do. You have questions. You're thinking of doing other things. Call us before you do something, because after you do it, it's usually too late. So call us first. We want to help you to make sure you make your best decision. And I know I always use Cy Sims' motto, an educated consumer is our best customer. And that's what we want to do. We want to educate you out there so you can make the best decision. And we're talking this week with Russ Gullo from RJ Gullo's company. If you like him, you could reach him at 716-675-1500. There you go, 675-1500. I knew I was going to get the third number wrong, so I let Russ say that. So 675-1500, you can get a hold of Russ or any of his crew. They'd love to help you. And we were just talking on break, and there's a great way. If you have children, unfortunately, children grow up and they get more expensive. And one of the biggest expenses besides a wedding for your children is college. And a 1031 exchange could help you with the college costs.
Absolutely, Chris. The opportunity being, if someone owns maybe a 4-unit building and they created all kinds of equity and they want to do a 1031 because they don't want to pay any tax, and they now have a child that's going to college, maybe going away to college, that client, that taxpayer, that exchanger could buy a single-family home, as an example, that they make available for rental. They can rent to a family member. There is case law that basically says as long as you charge at least 85% of the rent, fair market rent, it qualifies. And they can also bring in other friends that could live into that house, and now maybe they're going to a 4-year school. And after 4 years of making mortgage payments and the increase of value through appreciation and the principal pay down of a mortgage, that profit, that gain, basically offsets the cost of college, at that point,
right,
on paper.
Right. And they could, if they want to sell it, they could sell it, or they could exchange it for another property somewhere if they have another kid going to school or whatever.
Exactly.
They're looking for their retirement home.
Absolutely. Absolutely. It's a great tool, Chris, to put in that toolbox, pull it out when you need it.
Yeah, I mean, because I can tell you, I know I have a lot of clients who rent houses by UB, and they do it by bedroom, and they're getting $800 to $1,000 per bedroom.
It's unbelievable.
So,
it's unbelievable.
You buy a house for $200,000, and you have 3 people in there, including your child. You're making $3,000 for that house that your mortgage payment may only be $2,000. So now you got $1,000 a month that can go right to the college for the tuition.
Absolutely. It's great. It's a great opportunity, Chris. I think the other issue, Chris, that we see most often in the Western New York marketplace, as I mentioned, there's about 60,000 doubles and duplexes. And I'm sure you see this as well as I. People do not get the tax planning that they should get in advance. And you take that young married couple that want to own real estate, and they buy that double or that duplex, they occupy 1 unit, and now they've created some additional equity over the years, some appreciation, and maybe it's 10 years later now, and they think they can take their gain from both units, even though 1 unit's owner-occupied and the other unit's available for rental, and they think they can hide under the primary residence exclusion for both units. And that's not the case, is it?
No. Yeah, the primary residence exclusion, what was just talking about, as long as you live there 2 out of the last 5 years. For a married couple, the first $500,000 is tax-free. For a single person, it's $250,000. It's not the sale price. That's the gain. But like we said earlier, what happens with rental property? That depreciation. You're decreasing your basis. So you buy it for $200, you sell it for $200, you think, I didn't make any money, this was great. But after 27 and a half years, that $200,000 is all gain.
Right. And I think what we see quite often, Chris, is that young married couple that bought that double and now thinking, hey, I built this additional equity and now I'm starting a family and I want to go into a single family. I want to sell my double, which I only occupied one of the 2 units, and they don't realize the tax ramifications because they owe on that 1 unit that's been available for rental. And now the problem is if they don't get proper tax planning in advance, they commit to a purchase agreement to buy the single, and now what do? Come April when you realize, hey, I owe $20,000, $30,000, $40,000 in taxes.
Exactly. That's tough. That is a hard thing for people to when they come in with that. But what happens with the double when they have to allocate the sale price, half is rental, half, I know for taxes, that's what we have to do. But that's the same thing with the 1031 exchange if they wanted another rental property.
Exactly. So they could possibly buy a single to fulfill the 121 side, the primary, even though they don't have to. Right. They can take that money and go to OTB with it.
Exactly.
You're not forced to buy another primary, but you have to live somewhere. But they can, in addition, if they buy a single, they can buy another rental. They can buy a piece of raw land. Chris, maybe it's a piece of raw land that they're going to hold as investment without even making it available for rental. And maybe 10 years from now, maybe they want to build a primary residence on it.
I was just going to say that. Yeah. And how long would somebody in that situation who's in a double have to rent it in order for that other half now, the new half, to qualify for a 1031?
What we've seen for years, a minimum seasoning period of 2 years.
So they would have to rent it out for 2 years.
Make it available for rent. Now, it doesn't have to be rented. It has to be available for rental, but you'd want to have at least 2 years.
Okay, but the one they live in, not the one they're buying, the one they live in is what I'm saying.
Then to convert
if they want to say, well, we're moving out, it's now a rental, so we're renting out both halves.
12 months.
Okay.
Yeah, 12 months. I mean, that's, again, the taxpayers should seek out tax advice, but that's what we've seen historically over the years.
Well, wait, now here's my mind going. You got me going with where you just said, talking about where you can rent to family members. Could the husband rent to his wife?
I don't believe in New York State because we're not a community property state.
Okay.
But I just spoke with a client last night that's selling a multifamily that's buying a mixed-use building, and he's going to put his business, he owned personally, so he has to buy the same way he's selling, okay? So he has a deli that he's putting into the mixed-use building that he owns corporately. So he's going to lease, that corporation is going to lease from him personally.
Okay. And that brings up a good point, that if I have an LLC, right?
Right.
And the property I own is in the LLC has to do the exchange, not me.
The way you dispose, whatever the entity, or if you're a sole proprietor, that's how you have to buy. With the only exception to that, Chris, is if it's a single member disregarded LLC that does not have its own tax return. Okay, that's disregarded for tax purposes.
Okay.
That would qualify.
Okay.
And people would do that for asset protection purposes.
Right.
We see that quite often. But where most people get in trouble, Chris, is with the husband and wife filing jointly, but they own the property in a partnership. In an LLC that's treated as a partnership. And we're not a community property state. And so they need to buy in that LLC, which is being treated as a partnership, not as two tenants in common. And that's where we see most people getting in trouble. And, they would have to buy, basically in the name of that LLC.
Right. So this comes up to my next question, and people can see how my mind goes. Unfortunately, with marriage, there's divorce. What happens where it is a husband and wife who has a rental property in an LLC, they're getting a divorce, and they're forced to sell the property, but one of them wants to do an exchange so they don't pay taxes. Can they do that or no, because they are both owners of the LLC?
If they were both tenants in common, it would be much simpler. But yeah, there is a way that it could be done with the
Okay.
LLC. We'd have to keep
Okay.
that LLC. Possibly there is a way to do it by keeping the LLC alive and doing what we call a partial exchange.
Right. And then maybe you buy the other partner out.
Right.
So then it becomes a single owner
Right.
LLC. So you're not giving them the asset, the money from the asset.
Right.
You're just buying their
Yeah,
share
and
of the
again, it
asset
comes
out.
down to, is that LLC being treated as a partnership, or is it a disregarded with,
Right.
you know what I mean? That's
Yep.
something that would have to be addressed.
Yeah. Wow. So many scenarios, so confusing. But if you have questions on 1031 exchanges, please call Russ at 675-1500. He's located on Seneca Street in West Seneca. And I'm going to plug his daughter, who also has an awesome bakery. If you like some good Italian cookies, you could hook her up, get an exchange, and get some good Italian cookies. But, call, get your questions answered. Like you said, he'll do it for free, just like we'll help you for free with tax questions. So take advantage of this, please. But this Chris Fabian for EG Tax, our tax school is coming up in a month and a half. We got seminars coming up in September on the big, beautiful bill. You can go to our website for both. You can sign up, and, we'd love to see you, love to help you. And until next week, hope you enjoy the sunshine and the hot. Don't complain about the hot, because remember, in 5 months, what's going to be outside? We won't. The bad weather will be. But until next week, we'll see you then.